Hi, everybody. Jennifer Schaus here, coming to you live from Washington, D.C. today, and thanks for joining us in our Government Contractors Live Q&A Cafe. This is a webinar series that we held the second Friday of every month in 2021. Typically lasts about 90 minutes, and we've got 4 government contracting experts who will speak to you about today's topic, which is mergers and acquisitions. The recordings will be available using the same registration link. And if you're just looking for the PowerPoint slide, you can go to slideshare.net, and I believe you can log in there using your LinkedIn credentials. That'll give you the PowerPoint complimentary. And again, if you're looking for the recording, if you need to log off early today, you can use the same link that you used to register. And that should be available usually within about an hour after the webinar is completed. Just a quick blurb about us. We're based in downtown DC and provide professional consulting services for government contractors. We typically work with services companies, software firms, as well as product companies, helping them with market analysis and pipeline reports. We also help with proposal writing, GSA schedule assistance, and some of the other services that you see here on the slide. For more information, you can go to our website, which is simply jenniferschaus.com. And next, we want to thank our sponsors. First up is the Virginia PTAC. That's the Procurement Technical Assistance Center. They are based out of the George Mason University over in Fairfax, Virginia. And they provide counseling, one-on-one mentoring and training classes for government contractors, as well as aspiring government contractors. If you click on their any of their links, it'll take you to a calendar which will show you some of the classes and training that they have coming up. Next up is Crown Castle. They're an IT provider working both with the federal government as well as federal government contractors. Your point of contact there is Peter O'Brien. He's their BD guy for government. His contact information is found in the lower right-hand portion of your screen. We also want to thank our friends over at C3. They've contributed to our newsletter and webinars as an advertiser and sponsor for the last year and a half. They're our go-to for any company that's looking for CMMC certification or guidance as far as what's required these days or not. Your contact information for these guys is in the lower right-hand corner of your screen. We also want to thank WorkPlan, also another newsletter advertiser, and they provide an online platform for government contractors, helping with anything from DCAA compliance to capture management and contract management. Your point of contact there is Anita, and her phone number and email address are at the lower right-hand portion of your screen. The Federal Business Council also has contributed to many of our webinars and newsletter advertising. David Powell is your point of contact. His contact details are in the lower center of the screen. These are the Federal Business Council is a great organization putting on a lot of virtual and in-person events, sometimes at federal government agencies. And they're well known for their government procurement fair, which takes place usually in April of each year. We also want to thank our friends at Gov White Papers. Gov White Papers sprung out of Gov Events, and it's an online platform for sharing content, both published data from the government as well as government contractors. You can share your content there for free, just as you could your events on the Gov Events website. Your point of contact is Donna Monday, and you can see her email address there at the top right-hand corner of your screen. SWICTech, also a sponsor here of our webinars and newsletters. They're also a go-to for CMMC certification. They were early adopters of the CMMC program, and they are also a registered provider organization. Eric Clark is your point of contact, and he's at the top right-hand portion of your screen. Second to last here is Ocean 5 Strategies. They are our go-to for websites and SEO for both government contractors and commercial companies. They're great with messaging, marketing, strategic planning. Your point of contact there is Chris Brinker. She's a lovely lady, and her email address is there in the lower right-hand portion of your screen. Last but not least, our friends over at GovCon Wealth. They are a go-to for helping companies with wealth management. They work obviously a lot with government contractors. Your point of contact is Joe Cope, and you can see his email address there at the center of your screen. Okay, now on to today's program. Here we are in the final month, the final webinar for us for 2021, covering mergers and acquisitions in government contracting, which it's been a busy year, I believe, in 2021 for those sort of activities. So we want to thank our 4 panelists who have spent a lot of time putting together some great content slides and sharing their time, obviously, today. Kate Trendle with Kipps DeSanto and Companies. Kate, thanks so much for being with us today. We've also got Shirley Collier from Scale to Market. Shirley's participated in some of our webinars in the past and has been a good friend to us over the years. So thank you, Shirley, for joining us.
Thank you for having me.
Thank you. We've also got Joshua Dearman from Capital One. And Josh, we want to thank you also for your participation.
Thank you. Thanks for having me.
Great. And last but not least, Brad Jorgensen from DLA Piper. So we will go ahead and get started covering today's topic, M&A. And Kate, over to you. I'm going to mute myself and the floor is all yours.
And thanks again, Jennifer, for including me today. I'm super excited to be with the panel. And as you mentioned, I'm Kate Trendle. I'm a managing director with Kipps DeSanto. We actually are a subsidiary of Capital One, and we are a investment bank that focuses predominantly on aerospace, defense, and government services, and are very active in that sector. And as you mentioned, it has been an extremely active year from an M&A perspective. I'll walk through these slides at a high level and really just set the stage for what's going on in the M&A market and kind of GovCon market overall, which is really helping to fuel the level of activity that we're seeing kind of today. And some points are on this slide, but generally the market fundamentals for the government consulting, contracting marketplace could not be stronger right now. Businesses are well positioned, budgets are growing. The current administration, I think, has been much more favorable to defense and IC spending than originally thought. Certainly Biden is very focused on trying to increase budgetary spend for civilian agencies, which is also good for the sector, but he has not been incredibly bearish on defense spending and has noted a desire to increase IT spending across the DoD and IC with a focus around kind of RDT&E, IT, as I mentioned, cyberspace, et cetera. So all that is driving contract awards, revenue growth from the public companies as well as the smaller private companies. So we're looking at an industry that's thriving, doing well. Purchasers have access to ample capital, as I know Josh will talk about, but lenders are eager to lend and balance sheets are pretty healthy across the sector, and that is helping to fuel M&A activity to supplement organic growth. In addition, private equity also has access to that capital and has had a renewed increase in interest across the sector. So we're seeing private equity be unbelievably active in the sector. You can sort of see at the bottom of these 2 charts, the left has a handful of government services firms and kind of where they're standing from a public pricing trend standpoint. And then the right shows kind of the defense primes compared to kind of your traditional government services providers, and then also at the S&P. And while I know it looks like government may be lagging with respect to the S&P, and that's certainly true, the S&P has a number of the FANG and other IT companies that are just doing incredibly well from a historic standpoint, from a pricing standpoint. So even though government and defense is slightly below where the S&P is, they're still at and above kind of historic averages, and we would say a really healthy place. 12 times EBITDA, 11 times EBITDA is very high from a historic standpoint. So overall, the sector is kind of very well positioned. And maybe just going to the next chart, you can sort of see a little bit more from an M&A standpoint and how. Do I scroll down? Jennifer, to flip to the next slide, do I do that? Sorry, there we go. You can sort of see what is transpiring as a result of very active players in the sector, and that is really M&A growth. In the bottom right chart, really, I think in a snapshot, tells you where we are. This is the bottom right chart really shows M&A activity across just the government services landscape. This does not include aerospace and defense deals where the seller is creating or manufacturing a component. This would just be services, business companies or people companies, as well as software solutions. Prior to 2020, we saw 100 transactions a year was a great year, right? 111 in 2019. We would have argued that that was an incredibly frothy market, just given averages kind of in that 90 transactions a year range. And then in 2020, shockingly, in the middle of a pandemic, the market had about a 20% uptick, following a handful of months that were sidelined, March, April, when the world seemed to be ending, and then a tremendous pickup in activity towards the second half of the year, and that has fueled into 2021. And today we are on pace to do more than 200 transactions this calendar year, which is more than double what a healthy market would look like prior to the pandemic. Certainly, the pandemic has brought, I think, more interest into the government sector. Government budgets tend to be very secure, long-term budgets, and so in the middle of chaos in 2020, when there was a lot of unknowns in certain sectors, several private equity buyers and the like became much more interested in our sector and viewed it as sort of a safe haven. In addition, as I mentioned before, there's a ton of well-positioned buyers and sellers, right? And when you have well-positioned assets and buyers with ample capital, that just helps drive M&A activity. And thirdly, there is a fear from sellers of cap gains taxes going up, and so we have seen a number of business owners who have well-positioned businesses kind of come to us and say, hey, maybe in a different scenario, I might wait a year or two, but given where the market is and where valuations are, and also looming increases, potential increases in cap gains, I think doing something in 2021 makes sense. So certainly, I think there's a little bit of an uptick going on this year for that as well. And then the last thing I'll point out here is really the mix of buyer type. I mentioned how active private equity has been. If you look in that bottom right chart, you can see the various colors of buyers. So the dark blue would be privately held businesses being the acquirer. The light blue would be public companies. And then the gray would be private equity buyers buying a new portfolio investment. And then the yellow would be an existing private equity portfolio company making an acquisition of a subsequent company or an add-on acquisition. And you can really see where that gray and orange is growing as a percentage of overall activity, and just how impactful and how prolific the private equity group has become at just really helping to develop a middle market. So the last slide I'll highlight is, what drives value? Everyone we talk to says, gosh, it seems like every day I hear about a company selling for 10, 15, 20 times EBITDA. How do I get that, right? What makes their business, so great that they're getting these crazy, frothy multiples? And, yes, some of the headlines show some splashy deals that are trading for that 12, 15, 16 times range. I'd say that is it's a little bit heightened and maybe out of the ordinary this year. Those valuations are definitely high. Overall valuations are enhanced right now. So this chart really is looking at, maybe not the outlier valuations from 2021, but a more consistent kind of value landscape. When we talk to businesses about making decisions and what to think about, 2, 3, 5 years before a transaction, and what to focus growth on in order to maximize value. This chart kind of summarizes that. I don't necessarily need to go into all the details. I know Shirley's going to cover some of this in the next couple slides. But really, when you think about what buyers are most focused on acquiring, that's going to drive the highest multiple. And really, that's from a capability standpoint, it's being more on the IT mission side, as opposed to kind of doing lower end, more commoditized capabilities, more capabilities that may have some OCI considerations with the buyer community. But certainly all the buzzwords, cyber, AI, DevSecOps, data, that's going to drive kind of highest valuation parameters, as having embedded IP right? How sticky are your revenue streams and your capabilities? Are you doing something that's different than your competitor next to you, right? Do you have that embedded IP or some sort of stickiness that ensures that you'll get that recompete, or at least gives it the highest probability of success? And then from a contract standpoint, full and open prime is the holy grail, right? I think buyers are used to small and mid-tier businesses having some legacy set aside, but the more prime, full and open revenue streams, the higher that valuation will be. And then in today's world, when the government is becoming much more focused on best-in-class vehicles, having access to those vehicles, whether it's an Alliant, CIO, SP3, Astra was just awarded and it's getting a lot of excitement around it, et cetera. Those types of vehicles are definitely something that buyers are interested to acquire, particularly if they don't have that asset, that award position, or if they don't have the traction that they want. Acquiring a business that has some task orders on those vehicles is really, really attractive. And then lastly, around financial profile. At the end of the day, buyers are viewing M&A to supplement organic growth, right? So buying a business that has strong financial momentum, whether it's year-over-year revenue growth, strong margin characteristics, enhanced backlog, limited near-term recompete risk. Those are characteristics that buyers ascribe the highest level of value. We put two in the 10 to 12 times range. You can see there's a bullet down at the bottom right that shows more than 2.5 times LTM revenue backlog. Right? Do you have more than 2.5 times LTM revenue in backlog? That's what buyers are looking for. Which if you do, then you have limited recompete risk, et cetera. And then also around your pipeline, given what past performance you have, what's your pipeline looking like? What are you going after? How can your business and your past performance help them acquire or go after different opportunities as well to really have that 1 + 1 is greater than 2 kind of growth trajectory. So that's, kind of in a nutshell, what buyers are looking for and what kind of drives value. I think, Shirley, you're going to talk next a little bit about, how business owners should think about putting in place a few years in before a sale. And I think I'll turn it over to you, Shirley.
Thank you, Kate.
Real quick. Sorry, I'm just going to jump in real quick. Kate, thanks so much. When we get to your questions, if you can just maybe stick closer to the your microphone, your audio is just a little bit out. Yeah, that would be better. And
sorry
yeah,
about that.
If you guys have any questions, please feel free to type them into the chat, and we'll answer them in the order that they're received. And the questions are anonymous, so we won't read out your names. Okay.
Hi, I'm Shirley Collier. I'm the president and founder of Scale to Market and host of the Growth Masters Federal podcast. I work with company 3 to 5 years before they desire to sell. I focus on business development, the developing intellectual property, subject matter expertise, relationships, and as Kate mentioned, full and open contracts at hard to penetrate agencies that have healthy budgets. So where Kate has mentioned some of the factors that lead to market valuations, I help those federal contractors actually build that market value so they can exit at the level that they desire. The first step is for companies to assess their strengths. What are their differentiators, their past performance? They need to take a critical, objective look at where the company is right now. How is it positioned in the market? The second step is to conduct independent market research. Which agencies are buying what you sell? How do they buy? What contract vehicles do they use? From whom are they buying? And just as importantly, when will they buy again? Kate mentioned cyber, data analytics, and cloud that are highly valued. And she also mentioned a little bit about artificial intelligence. I wanted to emphasize that the use of artificial intelligence and machine learning is growing throughout the federal government, not only in defense, but in federal civilian agencies as well. Next slide. It's very important to develop a data-driven growth plan, not just shoot from the hip what you've heard from your neighbors or what you've heard from others, but to look at the objective information about the marketplace. It should include agencies, opportunities, contract vehicles, teaming partners, and strategies for penetrating those agencies and winning large, profitable contracts. Do you want a prime? Do you need to sub? What about a joint venture? Is that part of your plan? And who do you reach out to in these agencies and with their partners? What message will grab their attention? The market is very competitive. Small businesses must be better than the competition, and you have to prove it. You can't just go in and say we're really good people. So understanding how to demonstrate and pilot your capabilities to reduce the risk to agencies of trying new and innovative approaches, technologies, and contractors is the key to success. And once you have a plan or a roadmap, we like to call it a playbook, you have to execute. Do you have the business development staff to carry out that plan? Do you have disciplined, consistent processes for qualifying opportunities, assessing win probability, finding and collaborating with the right teaming partners, and submitting winning proposals for high margin contracts? And then can you deliver? Do you have the people, the management skills, and the financial resources to fulfill contracts, to perform at the highest levels on those obligations? Next slide. A business development function that has these characteristics that I just mentioned is what buyers are looking for. They want to see a healthy pipeline. Kate mentioned this just briefly. Not only the contracts that you have won and that you're executing on now, but what are the relationships, the systems, the disciplines, and the expertise that you've developed that will lead to future contracts. Many small businesses are afraid to pursue full and open opportunities. But if you have a niche and good past performance, small businesses should encourage contracting officers to use a full and open acquisition strategy for opportunities in which they are interested. It sounds high risk, but I've seen many small businesses use that strategy very successfully. As Kate mentioned, again, full and open contracts bring greater market value, and it is possible as a small business to win those full and open contracts. And not all agencies are created equal. Kate mentioned the Department of Defense and the intelligence community bring the greatest multiples, and for obvious reasons. Their budgets are huge. But market value is not always limited to those agencies. Health and Human Services, for example, specifically CMS, has a ton of money, but it's very hard to penetrate that agency. If you have a presence there, your company is probably in demand. And the last point that I want to make regarding increasing your company's market value is to hire good people. Buyers are always looking for competent, hardworking executives that possess both IQ and EQ. They want people with the technical skills, but they also want people who are growth-oriented, but also team players. The only word of caution here is to not pay your folks more than market value. They will have to fit into the cost structure and cost limitations of the acquiring company. So all of these things take time to think through, plan, and execute. It can't be done in 6 months. But with a 3 to 5 year horizon, I have seen companies grow from $10 million in annual sales to $50 million in annual sales and to command the highest market valuations. I have a pre-acquisition checklist for business owners that I will be sending to all of today's attendees. So this concludes my formal remarks.
Great. Well, thank you very much, Shirley. And Jennifer, thank you so much for having me on the webinar. My name is Joshua Dearman. I'm a managing director at Capital One. I'm part of our Aerospace, Defense, and Government Services group within the corporate bank. I primarily finance acquisitions in the government services market and really cover companies from founder-led, private equity-backed to all the large corporates as well. So that helps bring a pretty broad perspective to the table. And really, the remarks and slides I've prepared today, really taking a step back and looking at the market broadly and trying to give a perspective for both a company that's at an inflection point, whether it's you've decided to now move forward with an M&A strategy and go out and start acquiring other companies, or if you feel like you are at the point where you really need to consider hiring some professionals like some of my other panelists, esteemed panelists today, to be able to think about an exit. And really, either way, you need to build relationships. Shirley walked you through a little bit about how to really start that BD engine and really have good relationships on the client side. What I'm talking about is building relationships with service providers, other people in the market, really hear your story. I've listed a few here, but you really need to know the folks that are really active in the M&A market, and specifically in the sector or the size of the deals that you're working on as well. So, accountants, attorneys, bankers, of course, due diligence firms, but also being familiar with folks that, again, whether you're interested in exit or executing an M&A strategy, understanding those partners that could help you get there, whether that's, maybe you're at an inflection point and you need some additional capital through private equity to kind of get to that next level, or really, at the very least, building relationships with some strategics. I've also seen many times where a company has grown to a specific size, they've started relationships with smaller companies and they have a JV or a mentor-protege relationship, and eventually decide, what, maybe there is a better partnership here, maybe we can add them to the fold. So it's just broadening your network externally and making sure that you're talking to and building those relationships kind of across the board. And one way to do that is getting involved in some of the local associations that I've listed here. These are just a few. There's obviously a ton, but between ACG, the chamber, working with firms like Jennifer's and the panelists as well here, and just trying to build out that network more broadly is really key to really get your message out there. Next slide. So here I tried to pull back the curtain a little bit. Many times I have clients, especially founder-led growing companies, come to us and say, look, we're interested in starting an M&A strategy. We want to go out and acquire a company. They don't necessarily understand what we're going to look at from a banking institution. And this isn't specific to Capital One. This is broadly speaking. When you're looking for term financing or a acquisition, these are the key factors, especially within government services, that any bank is really going to look at to make sure that that it's that you could get approved for the actual term loan. So contract concentration is huge. Obviously, if you're building your firm, you've started that BD engine and you've won a lot of large contracts, there may be some concentration there, and really understanding the concentration and also the recompete risk. So if you have high concentration, but you have a long runway on that contract, that could help mitigate some of the risk. Set aside exposure. So how much of the business is set aside today? I would say, and I think Kay would agree, buyers have been less sensitive to set aside than they had in the past. The way that you really need to, the way that I've seen many folks be able to get past sort of a set aside issue is having a very strategic contract by contract plan of how I'm going to get from X percent set aside to full and open. And if you have that plan and it really creates a light at the end of the tunnel for the vision of the company, that's going to be key. prime versus sub. Obviously, Kate mentioned in her comments, prime, full, and open is sort of the holy grail of kind of the position you want to be in, and that creates value. But it also, from a lending perspective, creates an easier ability to be able to get approved for the credit facility. And then also competitive advantage. Think about it. When you present to a banker the plan to be able to go out and acquire another company, that banker has to go in and tell that story internally, right? So try to make it easy on them, both the story of your company and who you're looking to acquire. So really make sure that that blends together and that we understand what your competitive advantage is. As Kate mentioned, if the services are more commoditized, that's going to be a harder thing to finance than if it's a little bit more specialized. And then just margin profile sustainability. How are you going to be able to continue these margins? And will that change if you move to full and open, if you move to a new agency? And lastly, scale. And scale is something I'll talk about a little bit more down the road as well. But the more scale you have, the more diversity you're going to have in your revenue. And as your scale grows, you're able to tap different parts of the capital markets. And I'll cover off on that a little bit more. Last slide, please. So at the end of the day, whether, again, at an inflection point, whether you're looking to sell or start an M&A strategy, just getting your house in order makes sense. And Kate mentioned that too, just on the financing side, you have to make sure that you've built the relationships, but you've also put the right things in place. So making sure that you have audited financial statements, you have a contract waterfall and projection model that bankers can follow is key. Working with the accountants on quality of earnings, getting market studies from consulting firms. This is all the materials that a bank is going to need to be able to start that process, that lending process. But again, really being able to tell a bank what makes you special and differentiated is going to be key because, again, we're going to have that conversation internally. We need to be able to clearly articulate what your competitive advantage is, why you think or why you're able to compete against these other set of competitors, and why you're going to win these recompetes that you have coming up in 3 years or 2 years, and what that entire plan looks like. And lastly, really working with your bankers and getting multiple perspectives, really understanding what your debt capacity is. If you wanted to simply go out and execute on an M&A strategy on your own using your own balance sheet and what you could acquire with that path, what you could acquire if you actually were able to partner with a private equity firm and potentially accelerate the growth. And then on here I have bilateral syndicated club, early or fully syndicated high yield bond and investment grade bond. That's the general scale. There's some other points along the way, but if you're looking for, and I'll talk about it a little bit more. If you're looking for a cash flow deal, you need to generally have around 10 to 15 million of EBITDA, and you could start off at what's called a bilateral deal, which is basically a credit facility with one bank. But as you grow, you're going to need to get a syndicated facility where you may have 2 or 3 banks come into the transaction. As you grow that, you can start tapping other capital markets, and that's really where scale matters. So it matters on the front end on the approval so that you have diversification of revenue and you don't have that recompete cliff. But it also matters just from an investor base and who would actually be able to provide the financing, depending on the size and scale of the company. So with that, I think we have Brad up next to cover the legal side.
Great, thanks, Josh. This is Brad Jorgensen. I'm a partner at DLA Piper. In an earlier life, I worked at the government and I represented the government against the contractors in bid protests, contract claims, and the like. And about 12 years ago, I switched over to the private sector, and I've been at DLA Piper representing contractors against the government. We offer a full service of client counseling. My particular practice is focused in on government contractor mergers and acquisitions. DLA Piper has, I think, nearly 4,000 attorneys around the world. In the United States, we're consistently #1 as far as deal volume. Many of those deals involve government contractors. And my particular practice group, the Government Contracts Practice Group, is nationally ranked. My team is in Washington, D.C., and I'm actually located in Austin, Texas. And so we've talked a little bit today about the strength of the market and some key considerations as we're angling towards an M&A transaction. And now it's kind of nuts and bolts, nitty gritty. We've decided to consummate this transaction. If we're a buyer, how do we ensure that we're getting what we're paying for, that we're not unnecessarily, accepting risks and liabilities? If we're the seller, what can we expect in the context of this transaction? And so a lot of this hinges on the legal diligence. And as you can imagine, legal diligence in the government contractor M&A space is a little bit different than legal diligence in the non-government or just purely commercial space. And that's because at the end of the day, the counterparty is the government or a higher tier contractor. And there are sort of unique risks and obligations and opportunities, of course, in connection with that work. There's a saying that goes, you need to turn square corners when dealing with the government. And I've found that to be true. In a purely commercial arrangement, when things go sideways, one party may sue the other party and there may be some element of, monetary damages on the line. In the government contracting space, if things go sideways, given the counterparty, in the most egregious facts and circumstances, you could actually end up in jail, or, there could be a decrement or withholding against your other contracts, or you could potentially be excluded from the marketplace altogether. So the risks are certainly heightened. The benefits also are heightened in that the government's not going the way, the government pays typically a premium, and the government pays on time. And so there's a lot of sort of strength and security in the government marketplace. We just need to go into the M&A transaction with eyes wide open, and the way we do that is through diligence. If you've had a chance to look at any government contract ever, you might be surprised to see how many standard contract clauses are included in these documents. There may be, say, 3 to 5 pages of single-space contract clauses referenced, but if you go to actually track down each individual regulation that's being referenced and its subsequent, guidance and statutory underpinnings, before you know it, you've got a table full of paper, and all of that paper basically constitutes obligations, requirements that if you're going to sign up to this contract, those are now yours. And so, as you might understand, failure to satisfy those obligations could present, relatively significant, or in many cases, very significant risks and exposure. I've actually had situations where we'll do the diligence on behalf of the buyer, and we'll look at the government contract portfolio, and we'll, see that a bunch of contracts were set aside for small business concerns, and that in and of itself is not typically a big deal. But as we dig a little bit deeper and we try to sort of test the validity of the small business certifications that were made in order to be eligible for those awards, it has happened, unfortunately, with some regularity, where the target company, the seller, did not appreciate the significance of those small business representations, and in fact had, incorrectly certified themselves as small. And there's a bad line of cases out there that would suggest that if you falsely certified yourself as small, even if it was sort of unknowingly, just almost innocently, if you just didn't accurately certify yourself as small in connection with the Small Business Award, even in the situation where you successfully performed the work and the government effectively got what it bargained for, again, there's a bad line of cases out there that would provide that you'd be on the hook to the government potentially for 3 times the total value of the contract. So if the contract was awarded for 100 and you successfully performed all the work, but if the award is premised on a false certification, you could potentially owe the government back 300 even after having successfully performed. So obviously, as the buyer, we don't want to sign up for more liabilities than benefits, and certifications, small business certifications in particular, would be something important to look at during the diligence. And so let's go to the next slide. So in order to meaningfully assess these risks and liabilities that are unique to government work, the way the transaction would work is the buyer typically would send across to the seller a set of document requests and diligence questions. And those diligence questions and those document requests would focus in on sort of the key, risk or liability areas. And so if you're the seller, sometimes you'll feel burdened because you need to produce all of your government contracts, the modifications to those contracts, orders placed underneath them, sometimes your bids and proposals, correspondence with the government, audit reports, performance evaluations and the like. And the reason you're being asked to provide that is because the seller reasonably wants to understand what is it exactly that I'm buying, and potentially is there more liability than benefit here. So that's kind of the first step in the process is, these documents and this information would be requested. And the whole purpose of that is to kind of root out what are the operational and hidden operational risks and the hidden liabilities. We'll look at the revenue stream. What does your pipeline look like? Do you have any bids or proposals that are outstanding or pending? Are they with agencies or higher tier contractors that maybe historically you haven't worked with? So it'd be a new customer. Are they performing work that is not of the type typically performed by your company? So you're sort of swimming outside your lane, and perhaps there's a little bit more risk or liability attached to that new work, assuming the proposal is accepted and a government contract is awarded. And then, at the end of the day, what's happening here is, the deal is consummated via a purchase agreement. It's a contract between the buyer and the seller. And in connection with that purchase agreement, there will be embedded within it certain representations. And so if you're a seller and you do government work, either a lot or a little, you would probably expect that there'd be at least a section in your purchase agreement that would include seller representations as to these key government contract matters. The representations might include things, sort of as innocuous as, I represent that I've never been suspended or debarred, or that my principals have never been suspended or debarred, or that there are no open audits, or, there have been no mandatory disclosures, or there are no claims or protests, things of that nature. And so let's go to the next slide. These representations obviously give the buyer some level of comfort. The buyer has done, their own diligence. They've reviewed publicly available information. They've interviewed the targets, key personnel. They've reviewed the source documents. They've asked questions and received written responses. So they're feeling pretty good about sort of the lay of the land as they know it. And then the representations made by the buyer obviously also give some level of comfort. And if the buyer can't make any particular representation, they would need to disclose that. So for example, if the representation says the company has never received a CPARS or an evaluation rating of less than satisfactory, if there is one or two, off the wall evaluations that are less than satisfactory, the seller would have to disclose those in the form of a disclosure schedule against that particular representation. And so this gives kind of the buyer an eyes wide open appreciation for the nature of the government contract work and sort of the risk profile that they're signing up to by consummating this transaction. At the end of the day, though, sometimes these representations are not accurate, and the information disclosed is maybe not comprehensive or complete. And so what the buyer can do, and it's increasingly more popular, is the buyer can go out to a third-party insurer and purchase a policy that insures against a breach of these representations. And so to the extent post-closing, it turns up that there's some liability or some risk that arises that would result in sort of a monetary, damage to the buyer then could assert a claim against the third-party insurance company, as to the defective representation. And what I do, a large portion of my work obviously is representing buyers and sellers traditionally in a government contractor M&A context. And so diligence is near and dear to my heart, but a significant portion of my practice is actually also representing insurers. And so AIG, Euclid, Liberty, Berkshire Hathaway, any number of insurers that are working in this market, they're not going to just sort of willy-nilly issue an insurance policy. And so what they do is they do underwriting diligence, which is sort of a mirror of the buyer's side diligence, but maybe a light version. And so what they'll do is they'll hire me as outside counsel, the insurer will, and I'll go do diligence on the buyer's diligence to ensure that the buyer looked at the appropriate things and did an adequate enough job so that on behalf of the insurance company, I can represent, or recommend that, the insurance company is not unnecessarily taking on too much risk. And obviously the insurance company doesn't want to be used as sort of a proxy for buyer side diligence. So as a buyer, you can't just say, oh, well, I'm going to buy an insurance policy. I don't need to do any diligence. I'm passing all these risks along to the insurance company. If that's the case, there will just be a policy exclusion in sort of a blanket fashion against any, risks and liabilities related to government work. And so it gives me kind of an appreciation for what my peers are doing as far as the level of diligence, the idea of doing, underwriter diligence on diligence. And so I get sort of a great appreciation for the nature of the risks that are being assessed, the quality of the diligence, and sort of those items. And so this last slide that I have here, I've sort of flagged some of the key representations and warranties that you would expect to see in a purchase agreement where a government contractor is the target company. And you'll see that the representations will include things like, the contract backlog, if there's been any breaches or terminations, historically, or that are pending or maybe on the horizon. Sometimes those representations will talk about the exercise of option periods, perhaps whether the customer has stated an intent to renegotiate prices or labor rates. It might talk about the audit profile, maybe there's no pending DCAA audits, or there's been no question costs, or whatever the case might be. Payment of liquidated damages. So these are sort of the big risk areas that the buyer, I think, reasonably wants to run to ground, and they'll do this in the form of the pre-closing diligence, but then also these things would show up in connection with the purchase agreement and the representations baked into that. And then also, during the diligence, I've listed out in the bottom bullet here those topics that are most typically or most commonly addressed during the diligence phase. And so at the end of the day, I think the takeaway here is, the market is hot, there's tons of money, there's great benefits in doing government work, but at the end of the day, government work also carries some pretty unique risks and liabilities that for the most part are regulation or statutory based. And doing things the wrong way could significantly impact revenue stream or even the ability to do business moving forward. And given those risks in connection with this type of transaction, an ounce of prevention is worth a pound of cure is, certainly holds up in that, pre-close, and we want to do our diligence, we want to know what we're buying, we want to understand the risks and liabilities, and we want to do what we can in the context of the purchase agreement and the disclosure schedules to sort of hedge those risks and perhaps put them back on the seller in the event something happens post-closing, and or justify an insurance policy where we could maybe go to a third-party insurance provider for some level of comfort or cover in the event that something happens post-closing.
Thank you guys all so much. This was excellent content. And just a friendly reminder to the audience, if you do have any questions, please go ahead and type them into the chat box, which is in your control panel. It should be towards the bottom. We will read the questions off, or I will read the questions off in the order that they are received. So first, just a couple starter questions, and Kate, we'll start with you here. Hopefully your audio is back in action. What are the primary drivers for the increase in current M&A activity, and is it sustainable in 2022 and beyond?
Yeah, and please let me know if you can't hear me or if this is better, but okay, good. And I kind of alluded to this a little bit on my slides. I mean, it's sort of a perfect storm right now where you have well-positioned sellers that are growing, you have very eager buyers, both from a strategic standpoint, the public companies and privately held businesses, as well as private equity, all looking to put money to work and getting access to attractive financing. You've got budgets, an administration who wants to spend like drunken sailors, which is maybe not good for our wallets, but it's definitely good for the industry as a whole and for M&A. And you also have, a little bit of a fear of taxes going up. Now, I think that was more of a fear, call it in January, February, March, June of this year. I think now the fear of cap gains going to ordinary income levels is dissipated, but there is still a little bit of a thought that there could be a hike on cap gains. So that has really spiked 2021 deal volume to be supremely higher than what we have seen in recent years, if not ever, from a historic standpoint. Will we see 200 plus transactions occur in 2022? I personally don't think so. I think the market may be reaching a high from a volume standpoint in the government services sector in 2021, but the fundamentals are still there, right? So there's still a ton of well-positioned sellers. One thing that I didn't know earlier, but fascinatingly, in 2021. There was more private equity investments than selling, than exit opportunities. So you would think that in a market like this with valuations where they were, you would think some of the private equity groups that are in the market would be actively selling. And then, in fact, they're buying more than they're selling, which just shows a commitment in the sector and a belief that this market is not going to collapse anytime soon, and that M&A will continue to participate exist at these levels from a volume standpoint and more importantly, a valuation standpoint. So yes, I think the volume will come down from 200 or 200 and change, but I still think 2022 will be a frothy market. And hopefully we'll continue into 2023 as well.
Great, thank you. And next question goes over to Shirley. What is the biggest mistake small businesses make when contemplating selling their businesses?
I think that they are unaware that having small business set-aside contracts, it has less market value. So that's usually a shock to them to hear that, because some of these small business contracts can be pretty substantially sized. So one of the things that I do in working with my clients is making sure that they really leverage the small business set-aside program appropriately and strategically. So for example, there is the Mentor Protege JV program that will allow them, if there is a potential corporate buyer, a company that maybe they've done some subcontracting with, that company has expressed an interest in potentially eventually acquiring the smaller company. One way for them to sort of get engaged before they get married is to go after some larger opportunities under the MP JV program that will allow the mentor to participate 60% of that set-aside contract, but it also gives the parties an opportunity to work together. And I've hearing what Kate is saying about the private equity companies. I've seen a lot of that. In fact, I'm seeing some roll-up strategies that there's some mid-cap companies that are using the MP JV program to kind of scoop up high-value companies to increase their own market share so that they can eventually sell to a larger company.
Great, thank you. And our next question goes over to Josh. What are the top takeaways?
So from a lending relationship or a lending perspective, it's, again, building relationships with the right individuals across the board, the right service providers, but also management teams and making sure that your story is really out there. It's also just having a plan. If you have small business in your portfolio today, just really being able to articulate how you can grow out of the small business, or maybe it's this M&A transaction will be the catalyst for that. That's fine, but being able to properly articulate that and really outlining kind of why you're special, and not just from a capability or a customer set perspective, but things that banks are going to want to see, like high recompete win rates. Why is this contract waterfall sustainable through this 5-year period, and being able to articulate that. And then lastly, timing matters. If you have a really diverse portfolio and it's all prime, but everything is rolling off next year all at the same time, that's going to be a challenging credit for a bank to be able to finance. So think about the timing. If you have some nice big contract wins that have come through in the year, that have you set yourself up appropriately, like Shirley has outlined, and then obviously Kate, working with companies in those positions, once they've won some of those large contracts, can maybe go to market. So just consider those things as you think about sort of your long-term strategy.
Thank you. And Brad, over to you. What are the chief risks to address and mitigate through the diligence process?
Yeah, it's a great question. I think that, from a practical perspective, so we're setting aside the most egregious stuff, which is, folks go to jail and your name is, headline 1 on the New York Times. Setting aside that, which is, in my view, sort of egregious facts and circumstances. As a practical matter, I think that the legal risk that you're trying to most avoid is liability under the Civil False Claims Act. And that's the statute that gives the government the ability to demand treble damages. It's that statute that, say, a false certification in the small business context might result in the contractor paying back to the government 3x the total value of the contract. It's that statute that would perhaps require 3x repayment of some sort of an invoice that was erroneous. Maybe there was a labor charging issue, or folks without the proper education qualifications as outlined in the contract were performing work, yet the contractor still billed the government for the higher rate. And so, and it's also that same statute that might give rise to, treble damages under like a domestic preference requirement, the Buy American Act or the Trade Agreements Act, where if we're delivering goods, and we've made a certification that these goods comply with those statutes, whatever one might apply, and in fact they're not, we're sourcing our stuff from China or something like that, or we're filing off the markings and we're putting different made in country designations, it's that statute that could give rise to significant liability. And so the liability, the treble damages is obviously significant, but there's also sort of the headache and cost of just dealing with it. So the DOJ would maybe initiate proceedings against the company. We would need to spend money and time responding to those, proceedings. It could result in litigation. It could result in, some sort of a negotiated settlement, and all the while we're still trying to do the business of the company. And so it really kind of diverts your attention and could be, wildly disruptive. And so those are the chief risks in my mind from a practical matter that we're really trying to address during the diligence phase, in addition to obviously checking the box on sort of the most egregious stuff and making sure that those don't exist and aren't lingering out there also.
Okay, and Kate, back to you for this last prepped question. Can you provide some insight into current M&A valuations and how it compares to historic norms?
Yeah, this is a complicated question. And I'd probably say to look back at that slide that I showed where we had kind of the 3 buckets of value, below 8, 8 to 10, and 10 plus. That's, I would say, the historical averages. And what a seller should think about when they're anticipating a sale process and where the bucket they should fall in. I'd say that median transaction multiples are elevated right now, probably by about a turn or 2 across the entire industry, but you are also seeing the outlier valuations tick up even higher than that, right? So well-positioned businesses, which always will attract outlier valuations, meaning they're above that 10 to 12 times range, are probably getting an extra turn, 2 turns. Financing is very favorable, so that's probably contributing to a little bit of that. Right? If you can borrow 5.5 times as opposed to 4.5 times, it's easy to pay an extra turn. And then, buyers are also, either if they're strategic, public companies are trading themselves at higher multiples, or if it's private equity, having that access to cash and being a little bit more aggressive for well-positioned businesses. So you are seeing that average probably tick up, like I said, a turn, 2 turns, 2.5 turns from a median standpoint. But there's exceptions to kind of every rule. So that's kind of what I'd say now. I would say that sellers shouldn't bank and make decisions based on what we hear in the news. It's much better to be a little bit more conservative and think about historical norms and continue to focus on driving value at the micro level.
And Shirley, should I try to minimize overhead to make profits look greater before I put my business on the market?
This is a question that I get often from small businesses who are under the misconception that the short-term profits is what is going to drive valuation. And my advice always is to invest in growth, to invest in the proper infrastructure that's going to allow you to win larger, more profitable contracts, because the buyers can kind of see through any kind of short-term machinations that you've done with your books. So definitely invest. Don't squeeze your expenses. Don't squeeze your investments in anticipation of a transaction.
Okay, and Josh, why does scale matter and how does it impact financing?
Yeah, so what I would say, specific to government services, first of all, it's most government services companies are low capex, high free cash flow generating companies that, they have the federal government as their client. So in general, put that in one bucket that, it looks like a very solid credit. Add to that the fact that the capital markets are very liquid right now. And to Kate's point, it's driving a lot of the M&A volume because whether it's private equity investment or banks lending, it's definitely an open time to be able to finance your transactions. The reason scale really matters, and I walked through a little bit about this, it's first of all about your contract portfolio and diversification. So just because you have one contract and it drives $50 million worth of revenue in the business, that could be great, but if you don't have diversification, it could be challenging. So you need both. You need diversification of revenues and scale, but as you scale, you can, like I mentioned before, access different parts of the market. So when you're smaller, sort of sub 10 million of EBITDA, you're probably looking at an asset-backed either line of credit or term loan. So you're looking at sort of your receivables as the way that you're going to be able to finance going forward. If you hit sort of that $15 million of EBITDA or north, you can look at doing what would be considered a cash flow loan. So you're able to actually go beyond what you currently have from an asset perspective to be able to lever up a little bit to be able to do the transaction. As you scale further, you could look at a club syndicated facility. So that may be 2 or 3 banks. As you get to, call it 50 million of EBITDA, you can actually access the term loan B market, the leveraged loan market. You can either have a non-rated or a rated loan. And then you scale from there, high yield bonds and investment grade bonds. And again, we cover that entire market, which is exciting for me in corporate finance, but it's a great way to be able to see companies really kind of move through that value chain. A great example of a company that's really grown through that I think everyone probably is aware of, Dobell Technologies. I worked with the company when they were very small, helped them with their first line of credit, but also helped them with an acquisition that actually Kate's firm sold MSC to Dobell and helped them with, lead the transaction for that acquisition as they grew, eventually sold to Macquarie and have now sold to Guidehouse. So, there are definitely a lot of success stories where companies been able to kind of scale through that and be able to tap different financing markets throughout that time period.
Great, thank you. And Brad, last question, and then we'll use the last 30 minutes for the audience questions. So Brad, can representation and warranty insurance be purchased to mitigate the risk of the seller's defective disclosures?
Yeah, I think to some extent. So as I mentioned earlier, this is an insurance product that is increasingly more commonplace. I would say if the deal value is, say, $15 million or more, odds are, significant odds that, rep and warranty insurance will be purchased in connection with the transaction. I also mentioned earlier, however, that, the underwriter will do some degree of, underwriting diligence on the buyer's diligence to ensure that, they're not insuring risks or liabilities that are unknown or significant. And so, it can be purchased, yes. It certainly would help mitigate the risks in connection with the breach of the disclosures and the representations made in connection with the deal. But it should not be viewed as sort of a substitution for reasonable buy-side diligence. And I guess I would leave it at that.
Okay, now we're going to go over to the audience questions, which I'll read out in the order that they have come in. And let me just go to our slide here for the contact information and the questions again. Bear with me here. Okay. Can anyone talk about opportunities stemming from SBIR technology, specifically related to asset transfers and contract novations? Can the benefits of the SBIR program transfer to a large prime if they acquire a product developed under the SBIR program? Are there any successes that you could describe?
I don't know, Brad, if you want me to jump in, you're the legal expert, but absolutely. We love cyber businesses, particularly those businesses that have, I should say, migrated from the ones and twos to the threes. Threes are sole source, unrestricted awards, so they're not set aside. The ones and twos are small business contracts. We actually sold physical optics to Mercury at the end of December of last year. That was an all cyber-based business. They had sufficiently migrated the chasm from the ones and twos to the threes, and they were about 90-ish% cyber phase 3 awards as opposed to the set aside. They had some legacy set aside ones and twos, but predominantly sole source phase 3s. All of those in an equity transaction transfer directly to the buyer, and as long as the buyer continues to get those awards to the entity that they acquired. So in this situation, it was physical optics. The buyer, Mercury, can continue to get those awards, and they do. There's a ton of examples of buyers that have been very successful at maintaining cyber phase 3s, getting continual awards. Obviously, a large buyer will no longer be eligible for phase 1s and phase 2s. Because once they acquire that entity, they're no longer small, but certainly the phase 3s do. And I'd say that it is a construct that is very valuable when correctly understood by buyers. I will say a lot of buyers are fearful of what will happen and just don't have an appreciation for exactly what will happen with the cybers. So in that process and others that we have helped navigate with our clients, we've had to educate the buyers. And so working hand in hand with lawyers like Brad and making sure buyers understand the legal specifics around acquiring a cyber business is incredibly important, but it certainly can be done and does happen more often than it's probably made public.
Yeah, this is Brad. I would agree with all of that. I mean, the chief legal issue is with regard to the phase 1 and phase 2, those are set aside contracts, and the size standard is 500 employees, and you have to aggregate in all of your affiliates. So if there's a new buyer and they own a majority, or even if they own a minority of the company, but they have some sort of negative control rights that would allow them to sort of step in and block, corporate action or something like that, affiliation will be triggered, and you then have to aggregate in the head count, and that's where you could blow your size standard of 500 employees. The phase 1 and phase 2 are relatively low dollar value. The benefit is that with phase 1 and phase 2, you've gained relationships and traction within the agency, and you've angled yourself for that sole source phase 3, which is full and open and is the significant, monetary value driver. There's also a little bit of a wrinkle in the SBIR context that's unique to SBIR, and it deals with investment firms. There's some sort of strategic considerations with regard to the org structure post-closing. If it is that we don't exceed the 500 employee headcount number through aggregation, the second phase of that is we would need to look at our corporate structure and make sure that at least 51%, if there is going to be private equity ownership, that there only is one private equity owner, and that their percentage be at least 51% or greater. When you start to sort of break up the pie in different ways with different private equity stakeholders, you could run afoul of the organizational legal requirements that are unique to the SBIR program.
Okay, great, thank you. The next question is, are you guys going to get the slide deck and the recording? The answer there is yes. Now a more content related question. What are the best ways to find companies that might be interested in acquiring products, technology that we are considering divesting in?
Talk to a banker, talk to an investment banker, try to have lunch with somebody in the sector who is in tune to what buyers are looking for, and can kind of give you their lay of the land on who likely interested parties would be in what you're looking to divest.
I've also seen people successfully leverage their outside counsel that focuses in on the government contractor M&A space. They're operating in all of those industry groups. They have relationships with the bankers. Their clients are buyers or sellers, or at the very least are just familiar with that particular industry. And sometimes they can, to Josh's point, leverage those relationships that are so important.
Great. Okay. Any suggestions on the best ways to determine the value of a product being offered for an acquisition?
It's kind of the same thing. I mean, if I understand the question right, it's what would understanding what your inherent valuation might be in an M&A process. I think, we do that all the time for companies. Before we're engaged with clients, we meet with businesses, get an NDA in place, review financials, get to ask a handful of questions, and then give our thoughts as to what we would think that the market would likely bear for a valuation standpoint, who likely buyers would be, and help you make decisions on whether now's the time or if there's some other key business milestones that would be important in order to kind of maximizing near-term value.
I think that's right, but there's also some sort of unique considerations that may not show up in the profit loss column. Like, for example, would this transaction give me access to a new customer that would be otherwise hard to get into, or a new contract vehicle that I maybe don't have, or perhaps I'd like to start doing classified or cleared work, and this target, has a clearance, and rather than me working with DCSA and spending a bunch of money in 9 months standing up my own clearance, this entity could be my wholly owned cleared contractor entity, and that's now my vehicle for doing that type of work. So, there's certainly a lot of considerations that would go into the value, and that may even warrant paying more than, the dollars and cents valuation, in a particular context or case.
Great. Okay. In acquisitions, do companies buy the assets of these companies, or do they actually buy the company itself as it is?
I can jump in there. I think that maybe the question is, are all of the deals asset deals, or is there also maybe equity, purchases instead of asset purchases? And the answer is yes, all of the above. In the government contracting space, you need to do a novation of the prime contracts if assets required to perform the contract have been transferred. And so you can't, nobody can be in the business of buying contracts. The contract itself, contract number such and such, will never show up on a schedule of assets to be purchased. That would be a violation of law. But what you can do is you can purchase all of the assets required to perform the contract. So if it's human beings or intellectual property or equipment or facilities, those would show up on the schedule of assets purchased. The rub is that if you purchase the assets required to perform a contract, you have to do a formal novation, and that's a substitution of the contractor of record. It's an administrative task. It's a little bit of a headache, but it's not the end of the road. I'd be interested in what others have to say, but from my perspective, I'd say probably 80% of government contractor M&A deals are equity purchases, and the real reason for that is because you're avoiding the administrative headache of a novation for the most part.
Yeah, I'd say nearly all of our engagements result in a stock or equity transaction and not an asset. Typically, the only time we would do an asset is if someone's selling, a specific contract, or there's other reason for doing so. But by and large, they're almost all equity stock transactions for the reasons, Brad, you just mentioned. It's just the novation process is just long, burdensome, and painful.
Yeah, I would echo that. One other thing, although we don't have an accountant on the call, I think there's some tax implications in choosing which direction to go on that as well.
Great. Okay. The last speaker from DLA, Brad, that's you, obviously made reference to a line of cases which a larger acquirer ran into significant problems when acquiring a small business and continuing to perform on government contracts held by the small business after closing on the transaction. Can you identify one of those cases, and are there any actions that the acquirer could have taken to avoid such problems?
Yeah, it's actually a split in circuits is what it is. And there are circuits out there, and I haven't looked at this recently, but the last time I looked at it, I recall that there were 2 circuits out there where there are cases holding that a false certification in the context of a small business set-aside opportunity could give rise, and in certain cases actually did give rise to the 3x multiple damages under the Civil False Claims Act. the majority of the circuits don't hold that. The majority of the circuits hold that if the government receives some value for what they purchased, even if they weren't able to advance their socioeconomic goals, the government's sort of purpose in awarding the contract wasn't entirely frustrated. So there would be some sort of credit for the, the work successfully performed. It wouldn't just be wholesale, let's take the total value of the contract. The government was frustrated in its purposes, so the government gets 3x back. Another thing I would say is that 3x is the ceiling. If you were to scroll through DOJ's website where they've got all of the bounties that they've collected, it's a negotiated solution for the most part. And even when it does go to litigation, it could go to 3x being the multiplier, but usually folks are able to settle around 1 or 1.5. And sometimes they're even able to settle outside of the Civil False Claims Act, where it would just be a purely contractual remedy. So under the contract itself, there would be a repayment of funds or something like that occurring. So hopefully that's helpful, but no, unfortunately, I don't have, case names or anything like that handy right now.
Okay, great. Next question reads, what do you consider to be acceptable gross margin percentage? Are certain service sectors consistently earning better than average gross margins?
So I can maybe take a part of that, and then Kate, if you want to fill in. So gross margins are important, but the thing that we look at a lot is EBITDA and EBITDA margins. What really seems to impact margins in this business is not always the most intuitive. It's many times type of contract. So whether it's firm fixed price, you are typically able to garner higher margins in that scenario versus cost plus. And what is unique to this industry is that you could have a cost plus contract where you're providing very, very high end work, but your margins are very thin because of the way that the contract is structured. So we care more about sustainability of margins and making sure that throughout the cycle or the term of the loan that margins will either stay the same or improve, and that's really where we're focused. Kate, I don't know if you have a view.
Yeah, I mean, I'd just say it's so hard to answer that question without specifics on the type of business. I mean, we see businesses with 30% gross margins pre-fringe all the way up to 50 plus. Just depends on what your sub to DL percentage split is. Depends on, as Josh said, are you doing more cost plus, T&M, fixed price work, who your customer set is, right? The IC can garner higher bill rates and therefore gross margins, the type of work you're doing, contracts you're on. So I'd say it's really hard to answer that without knowing more specifics on the business, but I'd say it typically gross margins pre-fringe range, as I mentioned, between that kind of 30 to 50, huge range, but businesses are all different in kind of what they're doing and what the makeup looks like.
And I would reinforce that the gross margin is directly related to the differentiator that the contractor has. So if you have something that's unique, a specialized knowledge, process, technology, you can negotiate on the front end for higher margins.
Great, thank you all. Next question is, I've seen spending delays across agencies in 2021. Are PE firms patient enough while working through funding delays in GovCon, especially while dealing with smaller companies?
I mean, Josh, you deal with PE as well, and you usually are the ones that are behind the books, and you're usually the ones that are less patient when books aren't going well. But I'd say, by and large, I think that the folks that operate in this sector from a private equity standpoint, most of them are savvy in the sector and understand that delays are commonplace and a norm in this industry. And it's less about, I think they're patient as far as the whole period, right? Private equity doesn't need to sell in 1 year or 3 years. I think most of them target a 3 to 5 year hold. They also like to supplement with M&A. So there's organic delays in growth. The fastest way to supplement that is through M&A. So I think private equity and the Joshes of the world, the financing partners of the world are much more focused on kind of LTM and current cash flow and EBITDA trends, and your ability to service near-term debt. And then understanding that awards do take time, but needing to focus on how best to help a company grow. Josh?
Yeah, I would just add, I think it depends on the private equity firm, right? So what we've seen, Kate walked through the amount, the deal volume in M&A in the space. It's driven a lot of private equity interest from folks that maybe hadn't had as much experience. I would say there are firms that I think we're all familiar with that know the space very well, that are patient because they understand the government's dynamics, whether it's a specific agency issue that's driving a longer turn on award for a contract, or you've got several extensions on an existing sort of anchor contract. It's just whether or not that private equity firm is really well versed enough to be able to know that this is something that is a short-term issue that will be able to get by, or if it's a bigger problem. But I think the more sophisticated firms that have been in the space for quite a while, that understand it, that have hired the right management teams, that have really sort of built a franchise around it, do tend to be patient from that perspective.
Okay, great. And our next question reads, let's say an IDIQ schedule was just awarded. How does a PE firm value this contract? Hang on a second. How does a PE firm value this contract vehicle knowing that there is no revenue yet realized on this vehicle? I've seen contract vehicles with up to 30 or more master contract holders. How does the number of awardees influence valuation? Sorry, I kind of botched that question, but hopefully you guys understood it.
Yeah, I think it depends on what the vehicle is, right? If it's an 8A vehicle, hard to sell. If it's a small business vehicle, you're talking about a different buyer community that likely has a lower ability to spend a lot of dollars on a vehicle, so it's going to trade for a lower dollar amount. A naked vehicle, one with no task order, what we would say, if it's an in-demand, best-in-class vehicle, right, an Alliant 2, CIO SP3, you name it, it's probably selling, if it's prime, full and open, for about $1 million to $3 million. Now, the government has pushed back on selling of naked vehicles without task orders, so sometimes those won't get through, but when transactions have occurred, I'd say that that's typically the value, but it also depends on when it was awarded, how much backlog and pop remains, and what the vehicle is, right? I mean, Astra was just awarded, right? There's no market for that. That's a hot vehicle that people are looking at and wondering how lucrative that contract's going to be. Right now, probably really hard to get, $1 million or more unless you're on a number of pools. But if you are on some of those high-end pools, you might be able to get $1 million for that vehicle. But some of the less well-known, smaller IDIQs probably might not be as much of a demand or market for it. I think again, it just kind of comes down to exactly what vehicle it looks like, et cetera.
It could also help just accelerate a sale process for a potential tuck-in of another platform of a private equity firm. So if a private equity firm has a platform and they're looking for X vehicle and you just won it, that could drive a potential process to be able to sell the entire company if that is the thing that they've really been focused on and are looking to go after. The one caveat I would say, so that's the private equity view. The bank's view, just as Kate mentioned, we look at LTM. So for the last 12 months, what have you done on the vehicle? Well, nothing, because it's as Kate mentioned, it's a naked vehicle, doesn't have task orders under it. So it's not something that would be financeable. It's not going to add value from a financing perspective, but it very much could if it fits a gap in either a strategic or a platform of a private equity firm.
Okay, great. What would the makeup of the ideal team to work with respect to considering or preparing for a potential sale? For example, advisors, service providers focusing on various aspects of preparing for and completing a sale.
Who do you want to? Yeah, exactly. Kip Susanto, Capital One, DLA Piper.
There you go.
Shirley. No, I think it's, what I'd say is the best thing a seller can do before a transaction is to educate themselves with the types of advisors, right? Picking your team before you want to pull the trigger. There are a lot of investment bankers. Obviously, I think we're the best, right? Kip Sasano, but there are other advisors out there that could be a great fit as well. Same with lawyers and accountants. We typically encourage our advisors to get audits, at least 2 years prior to a sale. And we oftentimes do a quality of earnings assessment as part of a market launch, just before market launch. So there are a number of advisors, from accountants to lawyers to investment bankers, and just making sure that you can build a relationship with those individuals before deciding to pull a sale. Deciding to pull the trigger on a sale process. But yes, normally, we see companies looking to sell to have an investment banker as an advisor and an M&A attorney. Those are probably the first two advisors that typically get signed up right before a sale process. And then, as I mentioned, having quality of earnings advisor as well. And occasionally a market study advisor, which is a little bit less common, but certainly having an investment banker and an M&A attorney, signed up before a sale process is incredibly valuable.
Yeah, and in selecting your M&A attorney, I think it's a great question to ask the firm, do you have a practice group that focuses on government contracts? That is going to facilitate the transaction. You're going to be a good dance partner with any buyer that's coming on board. That's going to really yield great dividends. Or if they're just truly a sort of a corporate firm with no government contracts practice group, you would want to ask them, do you have any relationships with other firms where you could maybe bring on their government contract team as a specialist? Because you're necessarily going to need that in order to, at the very least, respond to these diligence questions, respond to underwriter questions, and basically move the deal forward.
I think that's
and I would say, if you don't mind me jumping here, Joshua, just as a business owner that has sold 4 businesses, it pays many times over to find an attorney that you like and that you trust, that you can work with, an investment banker that is really invested in your success and that is easy to work with. So definitely interview several before you make a final decision.
The reality is it's a relatively small, tight-knit community of folks. I mean, we all know each other. And at least from a lending perspective, there are times where companies will come to us and maybe we can't provide the financing, but we know folks that can. So it's about being able to tap your network and working with people that you trust that will give you the right advice and direct you appropriately if they're not able to execute for you.
Great. Okay. Next question. I heard Brad say that you can't sell or purchase a contract. It seems like the prime role on a product has value. Have you seen any cases where the position of being in the prime role is sold?
I'm not sure I totally understand it. Where I was coming from is it's a statute called the Anti-Assignment Act, and it actually expressly prohibits you from purchasing a contract. And the way you get around that, again, is you purchase the assets required to perform the contract, and then you novate the contract over to the buyer. And so that's how the process works, And I know that just sort of generally in conversation, we'll say we're purchasing the contract or whatever, but technically that's not allowed. The prime role certainly has value. You're interfacing directly with the government. You own the performance obligations. There's also a little bit of risk. I've heard today, from a financing perspective, it may be an issue if you're performing exclusively subcontracts, but from a government contracts compliance perspective, it's actually probably less risky to do subcontract work because your counterparty there is another commercial party. They may have flowed down certain obligations and standard contract clauses to you, but ultimately the government's going to wring their neck, and it would be incumbent upon them to turn around and then wring yours. So the government's not wringing your neck directly. That said, there's nothing like interfacing directly with the government, gaining that performance history, and really reaping the financial rewards of that.
Okay, and looks like we're down to our last minute here. We've got one last question. What is the typical cash flow multiplier for subcontracts?
A cash flow
Yeah,
multiplier.
I mean, that's really, yeah, go ahead.
I'm not fully following the question. Maybe the person could follow up with me like separately, and I'd be able to answer that.
Yeah, the only thing I'd say is if, a company was 100% sub, the valuation would be materially impacted, right? So if you were 100% sub, you would anticipate being at the lower end of that value spectrum, and it would be difficult to find a seller that was, to find a buyer that was, that could find a lot of strategic value in that. So if you're 30% sub and 70% prime, that doesn't apply. So I don't think you shouldn't hear that all subcontracts are bad. But the buyer community in today's landscape is less excited about all subcontracts.
Gotcha. Okay, great. Okay, and I think that rounds it up. It's the last of the questions, and we are exactly here at 1:30. So thanks to all of our great panelists. I enjoyed the different perspectives that you all brought. Thanks to the attendees who have joined us, and thank you guys for typing in your questions. This is the final webinar for us for 2021. We've got a great schedule for next year. That'll be up on our website shortly. So thanks again. Any last thoughts? We'll go around the table here. Shirley, we'll start with you as we close out. Anything you want to share with the audience?
No final thoughts specifically, except that for the small businesses that are listening, that there's enormous opportunity to grow your business and to cash out, to monetize the 60-hour work weeks that you've been putting in over 15 years, and you deserve it, and just look for good people to help you along the way.
Great. And Kate, any last final thoughts?
I would just say there's a lot of advisors out there that provide, free advice. That's what we do from a building relationship standpoint. So you can get a lot of informal advice from folks who live and breathe M&A, whether it's investment bankers or, someone like Shirley or Jennifer, who are helping businesses, prepare for M&A events, or, lawyers, et cetera. So take advantage of that. Get to know advisors in the community. They can help, you think through strategies before a sale process. We're always happy we do it all day long to grab lunch, coffee, and provide any insight we can. And then the last thing I'd just say is happy holidays and happy new year.
Great, thank you. And Brad, any last closing thoughts?
Let's see, I think I'm unmuted. Yeah, I would say that it's worth the headache. Government contracting in general is worth the headache, and certainly government contract M&A is worth the headache. My only advice is to go into both government contracting generally and government contracting M&A with your eyes wide open. Do your homework and figure out what the issues are, so that there are no surprises on the back end, or hopefully at least fewer surprises.
Okay, great. And Joshua?
Just to dovetail on what Kate said, I'm always happy to provide, I love corporate finance. I'm always happy to provide advice, grab lunch with anyone who is looking at either starting an M&A process or just has questions around capital structure or finance in general that we'd be able to help with.
Super. Okay. Well, thank you guys. I was kind of putting you on the spot there without any advance warning on those final thoughts. So appreciate your insight, and thanks for all the time that you guys took to put together the slides and share your content. Have a good rest of the weekend, good rest of the year. Merry Christmas, happy holidays, happy New Year, and we'll see you guys in 2022.
Bye, everyone.
Thank you. Bye-bye.